Joining me now to discuss the asset allocation in 2019 are Norman Willemin, his CIO at UBP, Thomas Heller, CIO at Schweizer Kantonalbank, and Lars Karl Breyer, CIO at Vontobel Wealth Management. Welcome, gentlemen, to this round of discussion. First of all, let me start with the simple question. Which is going to be the best asset class of 2019? Let me start with you, Norman.
We're looking a little bit far afield, if you like, for 2019, but we're looking to commodities. Outside of energy, especially in industrial commodities, we see a very nice supply-demand imbalance. And if we continue to see economic growth in the world, we think that's going to translate to higher prices for the year.
Commodities, that's where you are going to cash in, Norman. Thomas, what's your bet?
I mean, if things turn out well, and I think we're going to talk about that a bit later on, if things turn out well, I think emerging markets on the bond side will do pretty well next year.
EM bonds, let's see how things go there. And last but not least, Lars, your bet?
Yeah, for me as well, emerging markets, yet not only on the bond side, but also on the equity side. If we look at what's been happening to emerging market equities, they're not trading at a steep discount to developed markets, and that's usually quite positive for them.
Also because in 2018 we have seen the longest ever bull run in equities driven by the US stock markets. Thomas, what do you think about EM equities? Is it also an asset class that you're looking into?
Yeah, absolutely. But I still believe that the additional risk you're taking is probably will not pay off. So I'll stick with the more defensive bonds on the emerging markets. But I wouldn't disagree with what Lars just said.
And you, Norman, you were just nodding your head to what Thomas had to say. You're also kind of bullish in EM equities going forward?
On EM equities, for us, it really relies on China. And until China's growth starts to accelerate, until China in particular starts putting some stimulus in the economy, we think it's going to be very hard for EM, if you like, to get up off the mat. It's been a difficult year for EM. I think to the point Lars made on valuations, we think EM, it is cheap. But another place that is actually quite cheap that doesn't have the same problems we see in EM is Japan. So it's trading at deep discount, in particular to the US. We think it's one of the few places where the central banks are still standing aside. So we see Japan as an attractive place.
Perhaps if I could just add a comment on Japan. I mean, Japan is also a region where we have an overweight in our asset allocation.
What are the key factors there? Why are you so bullish?
The key reason is because everybody hates Japan. And in fact, if you look at international investors, most of them are always underweight Japan because you had a very long underperformance of the market. Yet what you can see is valuations being attractive. You see that corporate governance has in fact extremely improved over the last few years. You see that female participation in the workforce has also increased substantially. It's now higher than you have it in the US. And all these factors are not yet discounted in valuations. In the stock
I'm glad
prices.
you mentioned women there, that we are a driving force as well. Now, according to Thomson Reuters data, actually, earnings at S&P 500 companies are expected to jump by 10% next year. Is this a too optimistic outlook, do you think?
Well, first of all, they have already come down substantially from where the projections were, let's say, 3 or 4 months ago. At the time, projections were for high double-digit growth. 10%, if we do not get a further escalation in the trade war or the trade frictions between the US and China, is feasible. And it's not too optimistic.
Thomas, what kind of average annual return are you expecting in 2019? I know it's a long way to go, 12 months ahead of us, but still, what do you factor in?
I mean, actually, I think it will be a difficult year again. Hopefully, still things will turn out well, but it will be a difficult year. I don't think that markets will skyrocket or something. We'll not go back to 2016 or 2017. Not as negative as this year. But in low single-digit performance for stocks next year. That's what we expect.
You mentioned emerging market stocks that you're pretty optimistic and bullish on. What about US versus Eurozone corporate companies and stocks? Do you still favor US versus Eurozone companies?
If we look at Europe, as I think in terms of the economy, we think the risk of slowing in Europe is much more meaningful than in the US. On top of that, you have the ECB stepping away. On top of that, you have political issues, Italy, Brexit, as well as elections. So we think the headwinds are quite meaningful for Europe going into 2019. The valuations are cheap. We're not sure they're cheap enough at this point. So Europe versus the US, we think, is a difficult axis to be playing. We like US versus Japan much better.
If we break it down, Lars, and look at the specific sectors, which sector would you put your cash in? Is it more the healthcare companies, tech stocks, again, banks? Which sector are you favorable?
First of all, I wouldn't put all my money or the client's money in one specific sector. You need to be diversified also on a sector basis. Having said that, I see that defensive stocks have done extremely well in the recent past because of the risk aversion we had and the fears over and the uncertainty over trade. Now, we do expect that that's not a permanent state. We do expect that there will be a resolution on trade, and therefore the cyclical sectors, which have suffered very sharply over the last few months, they offer a better risk reward than the defensive sectors.
Do you agree with that, Thomas? Do you have any sector or maybe even company picks there?
I would agree. Diversification is still an important issue also for next year. I would go into the year more defensively, so probably stick to our healthcare stocks. And if things turn out well, if there's a resolution in the trade conflict, if that shows up, I think we could switch towards more cyclicals, maybe even to small and mid caps. They would do better, offer better value if things turn well. But I would go defensively into the year.
So to which extent do you think that the US-China trade war could actually hamper growth and especially earnings growth of companies in Europe and maybe even Switzerland?
Yeah, it could. I don't know to what amount or to what extent, but it has the potential to really bring to the world economy into recession. I don't think that will be the case, but it's a fine line. And it's not. We can't exclude that we turn into recession when trade conflict escalates further.
At UBP, Norman, what kind of scenarios are you working with? The worst case that there is a much bigger escalation of the US-China trade war, I imagine.
I mean, there certainly is a risk on US-China trade war, and we do believe the conflict is structural. And so this is something we're going to be talking about 5 years from now. But I think the way we're trying to navigate it is we can now see that both Trump as well as Xi recognize there's an economic floor that they want to defend. And I think Xi is now realizing at 6%, he's going to have to do something. He needs to strike a deal. Now that Trump is seeing volatility in markets, which he responds to, he wants to find a deal. So I think we find something. But then even with that, we must recognize China hasn't even responded domestically meaningfully in terms of policy. The Chinese, we think, could ease very dramatically, and that would be very positive for the global economy in 2019.
Absolutely, all eyes on China and PBOC policy there as well, local government debt, a lot of challenges for the Chinese economy. Let's move to another asset class, which is fixed income. Lars, are you pro high yield government debt, corporate debt? What bonds are you interested in 2019?
Well, I'd be very careful on high yield. And the reason for that is high yield is an asset class which has been boosted for many years by the unconventional monetary policy. It has created some distortions in that sector. Some companies shouldn't be alive, and they are alive just because the monetary policy was so unconventional. On top of that, you have many retail investors who had never invested before in high yield, who invested in high yield, and many of them invested via ETFs. So you have potentially an asset class which is likely to suffer from a normalization of interest rates, which is potentially liquid and which has investors who never really invested in the. That's why I would be cautious on that.
A lot of traders and strategists are also very cautious when it comes to emerging market high-yield bonds because they carry a significant risk. Would you also stay away from those, Thomas?
From high yield in emerging markets, so I agree with Lars that there's some risk in the high yield sector. But as I mentioned at the beginning, overall, I see emerging market bonds have some value next year if the economy at least doesn't slow too much. The dollar strength might come to an end. Interest rate cycle comes to an end in the US. That would support emerging market bonds. So I'm not negative on the emerging market bonds overall. I'll be cautious on high yield as well.
What's your take, Norman, there?
We've been out of high yield all of 2018, and we'll probably stay the same in 2019. I think for investors in bonds like 2018, it's going to be a year of risk management.
You're just staying away from taking too much risk, right? But what about US Treasuries or Eurozone government bonds? Are you more bullish on those? Despite Italy's crisis we've seen in 2018?
Eurozone government bonds, we don't find that attractive. I think for investors in Euro who are looking for, if you like, lower risk exposure, we see Danish mortgage as a very interesting place to be. One, it's AAA. Two, it gives us positive yield. In the context of Euro, reasonably positive yield compared to 30 basis points in bonds. And it gives us a good exposure to a good market, we think. And so there's very few places to hide in Euro. On the Treasury side, we do have some short duration Treasury. We like the short end of the curve because we think the Fed is probably going to finish their hiking cycle.
And at the end of the day, the T-bills, they will still stay a safe haven investment in 2019, isn't it?
It'll stay a safe haven, but as the Fed ends its hiking cycle, you should see short duration bonds start to rise in value. But I think another thing that we're looking at in the Treasury markets, as the Fed steps away, usually what you tend to see happening is the yield curves start to steepen. And so we're looking at steepener strategies for the Treasury market.
What about local currency emerging market bonds, Lars? A lot of investors and analysts expect a higher return of like plus 4% in that segment. Would you agree with that?
Well, if you take a step back, local emerging market bonds have suffered substantially in 2018. And the key reason for that was the strength of the US dollar, which has very much weakened this asset class. Now, our house view is that the US dollar has peaked, is not likely to appreciate much further, because as Norman said, we do expect that the Fed will soon be done increasing interest rates. And that is something which, again, is supportive for local emerging market bonds. And that's why these 4% are very realistic. They're not bullish.
Talking about US Fed policy, most investors, economists expect 2 to 3 interest rate hikes. You expect 2, I believe, Thomas. How will the interest rate hikes by the US Fed impact your portfolio and strategy?
Yeah, as I said, we were expecting two hikes. We always think about investing in treasuries because there you have some yield at least compared to Switzerland, where it's negative, or in Eurozone, where it's only slightly positive. But as we don't want to take the exchange rate, the currency risk, we would typically hedge back, and then you lose all of the advantage. So at the end of the day, we typically don't invest in treasuries. Because it's not worth the effort, and then you either take the currency risk or you lose everything by hedging the currency.
You mentioned Forex, and this is the next asset class I want to talk to you about. The US dollar has started to trend a little bit lower. Do you expect the greenback to weaken and depreciate from here, which would be good for precious metals, Norman?
Yeah, we think that that's a second half of 2019 probability, especially as we come through a lot of the political uncertainty in Europe, as we come through Brexit. then you can see the undervaluation of things like sterling start to reverse going forward, and the euro can start to pick itself up and maybe strengthen from here. But until then, we think it's going to be quite choppy for the dollar in the first half.
So keeping your hands off Forex markets more or less, but what will all of this mean for the Swiss franc, Lars?
Well, the Swiss franc has appreciated throughout the year. It's now trading at 112 versus the euro. We do not believe it's going to weaken much further from here. And the key reason, especially against the euro, and the key reason for that is that the yield differential between the Swiss franc and the euro is probably going to stay roughly the same. The other thing which is important is that some of the political uncertainty which we have in the Eurozone, they will stay with us certainly in the first quarter of the year. And that still supports the Swiss franc and would keep them at the current levels.
If we mention Forex, we also have to talk about oil, of course. Now, the oversupply in the crude market has led to a sharp drop in Brent crude spot prices since October as well. How do you see the oversupply in the oil sector, and what is your outlook there?
A lot of the oil-producing countries will not want the oil price go below, let's say, on Brent below 60 or much further than that.
So what will this mean for your asset allocation now?
I mean, I wouldn't buy oil. It could be a tactical bet. We don't have it strategically in our portfolios. Could be a tactical bet. It might go back, talking about Brent, towards 70, maybe to 80, but not much more. And we're not willing to take that risk, the volatility we're taking into the portfolio.
Norman, are you also excluding oil from your portfolio?
I mean, we don't trade oil as a commodity, but we certainly trade energy stocks. I mean, we're of the view, I think, as rightly pointed out, OPEC Plus, if you like, is taking out 1.2, 1.3 million barrels a day. That should balance the market. And so the issue really is, what does growth look like? What does demand look like? And we think demand should look reasonably firm next year. If you look at that compared to, in particular, where European energy stocks, and they've gotten hurt with the oil sell down, you're getting very good dividend yields, very good production growth. European energy stocks are trading quite cheaply. We think that's an interesting place to look following the sell-off in oil in the last couple months.
A diversified portfolio strategy, that's the key word here. Now, before we go, each of you, your golden investment rule for 2019, in a couple of words, what will it be, Norman?
I do think it's going to be somewhat opportunistic for 2019 because we have quite a number of events through the year that have the potential to destabilize. But as we've seen over the last couple of months, some of that instability is going to create opportunities for investors to find good value and deploy resources into the market.
Thomas, your golden rule for the new year?
I would agree to some extent with the opportunistic approach, but in general, just because we had some turmoils in the market recently, so the basic rules for investment hasn't changed. So be diversified, be invested. That's what we tell our clients all the time, because as soon as markets start to stumble, they want to get out. We say, stay invested, be diversified, and I think that's a good rule for 2019 as well.
Lars, any top tip before we go?
I think the key things investors should be thinking about is there's always more risk in the long run not to be invested than to be invested. In fact, if you're in cash, that is something which can work well for a certain period of time, but over the long run, you will always underperform a well-diversified portfolio.
That's all great advice. Thank you so much for joining us, gentlemen. There's plenty more to come on the Swiss Pulse, so don't go away.